Hi, this is Justin McNichols with Osborne Partners, and today I'm excited to present to you our 2022 review and 2023 preview. We have a lot of exciting slides for you and a lot of information, so let's get started. First, as a review, investors faced an absolutely unprecedented combination of headwinds last year. Everything from the Federal Reserve increasing short-term interest rates from basically 0 to 4.5%, to inflation spiking the fastest and highest since the 1970s, while at the same time the Chinese economy was closed for most of the year due to COVID, and Russia started a war with Ukraine. So that mix ended up having 2022 see very poor results overall, usually somewhere between down and devastating for most investors. There were only a couple asset classes that fared well last year, and I'm going to review all the asset classes now just to show you how severe the returns were last year. So first, in fixed income, usually the income generation risk reduction asset class was the worst performance on record in history, period, down 13%. Alternative investments had their worst year since 2008. Natural resources, actually, with the inflation spike, performed very well. That was a tailwind for our portfolios, generally up about 16%. U.S. equities had the fourth worst year since 1960, down 19% or so in the S&P 500, down 32% in the NASDAQ. Real estate had its worst year since 2008. All of the speculative areas, obviously SPACs and IPOs and innovation type stocks and companies that are not profitable, those were down typically 60% or more. And then crypto, a lot of cases, just down 100%. The good news is, depending on the client allocation here at Osborne Partners, most Osborne Partners portfolios captured less of the negative return of global equities, had less volatility than global equities, and actually we had positive returns in three asset classes that we tactically maneuver between. Natural resources, our alternative investments, which are generally our hedges, and cash were all positive returns to the portfolio. As we look at a 2023 preview, basically the idea is that the unknowns of last year become knowns this year. The first one's inflation. As you probably know, inflation peaked at over 9% last year on a CPI basis. And inflation now has come down for multiple months and is approaching a level that we could call more average over time. And we feel that we'll see CPI continue to fall throughout 2023. In looking at inflation peaking, this is a metric that we use in the investment team. It's the supplier delivery index. When this chart goes down, that basically is a sign that inflation is going to go down, meaning delivery times are much easier for manufacturers, meaning they're able to get parts, meaning those parts aren't necessarily expensive, and there's plenty of a supply of it. So this is another great indication that inflation's headed lower. If we look at interest rates, another unknown becoming a known. At this time last year, the idea was the Fed may not even raise interest rates. A few short months later in 2022, with inflation being really high and the Fed being very aggressive raising rates, the idea was that maybe the Fed funds rate would be increased up to 6-7% or more. Now, it looks like, based on expectations, that we are probably 90% of the way through this Fed funds increase and this rate hiking cycle, as we are presently at 4.25 to 4.5% on the Fed funds, probably peaking out at just around 5%. The opportunities in 2023, we just feel there are more of them than 2022. First, in domestic equities, through October of 2022, valuation multiples fell 30%. Now the question is, when and where will earnings trough? Foreign equities look like they should bottom before the U.S. and are already starting to outperform the U.S. here in late 22, early 23. Natural resources, we reduced exposure, as you know, as inflation was peaking last year, but we see select opportunities that we'll talk about. Real estate, we have a neutral stance. Alternatives, a lot of our hedges from last year are no longer needed. If you look at fixed income, we're finding many high quality corporate bonds yielding well over 5%. And cash, what's interesting now is our tactical cash is earning over 4% just for us to wait for superior risk return opportunities. So I'm going to preview the asset classes briefly. First, domestic equities. So in October 2022, our team as a team itself had the longest investment idea watch list since the first quarter of 2020 during the peak of the pandemic. And some of the areas where we started adding to domestic equities were defensive compounding growth companies, overly punished growth companies, and cyclical technology. As you can see here from the chart, valuations fell back to the long-term averages. In looking at foreign equities, our kind of acronym here is FIFO, first in a recession, first out of a recession. And we feel that most likely more parts outside the United States will complete their negative earnings revision cycle before the US, while at the same time, foreign equities as a whole traded a 30% discount to the US. So we think that, coupled with the fact that most investors are extremely underweight foreign equities, we think that they have a great opportunity to outperform this year. Moving on to natural resources, as you know as clients, and as I mentioned, we reduced exposure to natural resources in the middle of last year as inflation peaked. It was a great tailwind for the portfolio, but we continue to see great opportunities, and here's an example of one. The question for us is, what happens when China reopens their economy and copper, which we show the chart here of its inventory, what happens when the copper inventory is this low? We think there's a great opportunity for copper. In real estate, we have neutral positioning, but we do not feel that there will be some kind of real estate depression as many people feel. We've got two charts here. First, housing inventories, which are basically at a 40-year low, and housing starts, which are now 20% below average and falling. So even though interest rates have put housing on kind of the back burner and have not, housing has not performed that well as interest rates have increased, the fundamentals with supply are excellent. Looking at alternative investments, as you know, we had a number of hedges on last year, which helped the portfolio. But toward the end of last year, we reduced our long US dollar hedge. We exited our upside interest rate hedge. We sold our volatility hedge. And at this point, we have no niche sub-asset classes. However, private equity is becoming very interesting to us. So we are examining a number of publicly held private equity companies. Looking at fixed income. Fixed income, as you can see from this chart, had the absolute worst performance on record, down 13%, and at one point was down 17% for the year. This was our most underweight asset class from 2016 until the middle of 22, when we suddenly found some amazing opportunities, especially in the corporate bond area. In looking at fixed income's yields and return last year, if you break down the asset class itself here, where we have the total aggregate, investment grade corporates, convertibles, high yields, municipals, et cetera, you can see a huge difference between how they yield, what the yield was in the end of 21 versus the end of 22. And then you can see these returns, a lot of double-digit negative returns last year, but yields are excellent now, especially versus last year. So we really appreciate you listening to our presentation and preview of 22 and 23. And we're also excited that we are going to deliver for you about 5 more videos over the next few weeks that drill down into each individual asset class and tell you what the investment team is thinking from an asset class level. So we really appreciate your time, and we look forward to presenting our next video to you soon.